Barton Gold is an ASX-listed Australian gold exploration company with a total attributable of 1.3 million ounces of gold, JORC Mineral Resource endowment, which is a hefty endowment so far, and they're looking to build on it. They have a pipeline of advanced exploration projects and brownfield mines, and 100% ownership of the only regional gold mill in the central Gawler Craton of South Australia. So that's in the middle of South Australia. In June, Barton completed a 3.5 million Australian dollar placing to institutional and sophisticated investors with a further 1 million, or it's 1 million plus, it's 1.2 million, I think, share purchase plan just completed. So that went very well. The business currently has 14.75 million Australian dollars, Aussie dollars worth of cash and gold in concentrates. MD and CEO Alex Scanlon joins us live from Adelaide, where I do believe it's 3 o'clock in the morning. Welcome, Alex.
Good morning, Donald. How are you?
This is how weary are you feeling?
Yeah, I'm fine. I've been up for a little bit and I've had plenty of coffee, so
You're
don't
feeling
worry.
all right. Well, very grateful to have you here all the way live from Adelaide in the middle of the night. So thank you very much indeed, Alex. Would you want to take us through your presentation? That would be great if you could.
Sure. Can everybody see our presentation up on screen there?
We can indeed.
Great. Okay. So before we jump into the presentation itself, just in terms of the cover shot there, one thing to highlight, that's not a stock photo. That's actually a photograph of a high-grade open pit that we have at our Tarkwa project. So I'll come back to that and explain why that's relevant to sort of our stage development plan as we go through the presentation. But just starting on kind of our overview slide here on our presentation, for those of you who are not familiar with the Barton Gold story, our story is at once pretty simple and then very multifaceted. So we are a South Australian focused gold developer. We are very interested in the state of South Australia because it actually contains 25% of Australia's known gold mineral resources, but really speaks for only about 2% of annual production. And this is really a product of an historical legacy of investment and development, which has been biased toward copper and uranium development in the state. And a lot of this has taken place in the very center of the Gawler Craton, where we are. So this is a very widely known mineral district. And it just so happens that just to the west of the iron oxide copper gold belt, the district that BHP has just essentially fully consolidated by acquiring Oz Minerals. So it now owns Olympic Dam, Carrapateena, and Prominent Hill. On the other side of the highway, quite literally, there is an historic gold district called the Central Gawler Gold Province. This is a province with about a 130-year history of high-grade gold production. And in this province, we have very carefully assembled essentially a ground package which contains every significant historical producing and exploration gold asset. So we have, in short, built up a ground position of just over 5,000 square kilometers. And in the past few years, we have now built up a JORC Resources base of about 1.3 million ounces. And we also own the only gold mill in the region. So this is a mill that was producing in 2018 from some of the assets that we own. It's on care and maintenance, and it's something that we can reanimate for relatively low cost. So that's kind of the package in summary. What are we doing? That is it. Why are we doing it? Well, we are looking at the much larger and multi-million ounce resource potential of the Central Gawler Craton. We do know that there is significant gold endowment. Our Tunkillia project is the largest undeveloped gold-only resource in South Australia. And so we are not just rushing these assets back into operation using our mill. Noting, however, that that mill does provide us very strong strategic leverage to not only our own assets, but other regional assets as we move forward in the stage development plan. So in summary for us, our corporate focus is very, very clear. We aren't chasing rare earths in a different jurisdiction or nickel in Africa. It's gold in South Australia. Our time, our people, and our money is very focused. We believe that is a pathway to success. We have a very strong platform, and as you mentioned, we are extremely well capitalized. We have the perhaps unique circumstance of actually being a concentrates producer simply as a byproduct of some of the work that we do on our infrastructure. So as we look at our capital structure before we get into the projects, we have a very simple, clean capital structure. We have about 195 million shares on issue. Our market capitalization is around $50 million Australian, or once you factor all of our cash on hand of just over $10 million, we have an enterprise value of around $40 million Australian, or say 30 million US, or 25 million in terms of pounds sterling. And as we mentioned, we also do actually hold about $3.4 million worth of gold in concentrates on hand. So from an enterprise value basis, Barton is certainly a sort of very compelling value proposition for what you get in terms of this infrastructure platform, plus the resources, plus our ability to actually generate capital. And we have started to perform quite well over the past year in particular, I think, as we've really broken away from the market trends, as I think the market has started to recognize these things. And one of the reasons too, I think that I think one of the reasons for our strong outperformance and our sort of, let's say, creative footwork is that we do have a very strong principal interest in the outcomes here. So we have very strong board and management alignment with shareholders. So the board and management represent about 1/4 interest in this company. And together with our institutional and corporate partners, board and management and institutional and corporate speak for about 40% of the register. So it's a very strong register, sort of in terms of its shape. We have some very, very strong specialized institutional funds, including several who have recently joined us, and a very strong board and management alignment with the balance of the shareholding. And when we think about the capital structure of the company, it's important to think also about human capital. So looking at our personnel, we have built a team that really reflects not only our forward ambitions, but brings a lot of capability in terms of diverse experience and skill sets to our board. So when you look at our senior team, and I'm just talking about the board and our sort of senior management team, we have a team that has over 200 years of experience exploring for permitting, financing, developing, and operating major mineral resource assets, with a particularly strong pedigree both in South Australia and gold. So those sharp-eyed readers who are looking closely at the screen might notice that 3 of our senior team are formerly of Normandy Mining and Newmont Mining. So Normandy Mining, the news today in the gold space is that Newcrest is being purchased by Newmont. 20 years ago, the big news was that Normandy Mining was being purchased by Newmont to enter Australia. Normandy was Australia's largest gold producer through the end of the 1900s, the late 1990s, and going into early 2000s. My chairman was the former CFO of Normandy and Newmont, and we also have our project managers and exploration team drawn from that team. We also have expertise developing and running uranium assets for the subsidiary of a U.S. defense contractor in South Australia, which is about as complicated as it can get from a regulatory standpoint. And we even have a mill specialist on our board. So really comprehensive skill sets. And that's what's really setting us up for and driving our pathway towards operations. So, when we think about those operations now and our corporate ambition, if we sort of step back up to the corporate level, we've got our platform, we've got our team, and, where are we going? Our ambition as a company is to take these assets, again, build them up to a multi-million ounce operating resource base, and to become South Australia's largest independent gold producer in about 5 years' time. And importantly, what that means is, to break that down, is what we're looking to do is to be producing around 150,000 ounces per annum of gold. And importantly, we're looking to do that in a series of stages. We're not looking to just make one big jump from, say, 0 ounces of production to 150,000 ounces of production. We have the ability to leverage our existing infrastructure and existing mining leases to enter into stage 1 production on a much lower cost, much lower risk basis, so that our expansion, if you will, or the increase to a much larger amount of production, is not just one big almighty jump from 0 to 150. It's an expansion of operations and we can do it off the back of cash flows derived of our first assets and operations. So what we're looking at doing here to achieve this is really looking at bulk open pitable mineralization at Tunkillia, and we're looking at shallow high-grade mineralization at Tarcoola. And so those two assets really are one project that will operate together and in tandem in the long run. They're only 70 kilometers apart. We have about 3,000 square kilometers of ground. We have well over 100 kilometers of major structures mapped there. And on less than 2% of those structures, we already have 1.2 million ounces. So we are going for big, we are going for efficient, and we are going for the ability to leverage our existing infrastructure into operations and then expansion into stage two, big bulk operations. And the reason we are interested in big bulk open pit operations for our stage two expansion is that it works better than anything everywhere all the time. In really simple terms, mining is little more than the volumetric efficiencies of blasting and lifting and moving and processing material. So we are looking for big bulk open pit for that stage two. And when we are looking at that, we actually look to other sort of analogs in the market for, why are we doing this and how are we going to do it? Why do we want to pursue that strategy? The strategy for Tunkillia as that stage two expansion, it was really based upon our analysis of open pit versus underground operations in Australia. And we actually looked to a group called Capricorn Metals, which is listed on the ASX as well. They are a very well-known gold developer. They purchased a project known as Karlawinda back in 2015. And that Karlawinda project looked a lot like, or I should say our Tunkillia project, when we were looking at it, looked a lot like the early days of Karlawinda. So Karlawinda, when it was acquired, was about a 650,000 ounce asset. Capricorn grew it to about 900,000 ounces, and then 1.1 and 1.3 and 1.5 million ounces. And they've continued to grow it. It's now about a 2.3 million ounce resource. But importantly, it's a 0.7 gram per ton resource, which is something that in Australia people would traditionally think of as quite low grade because we're used to high grade underground mining. However, Capricorn has built this into a big bulk open pit, and it is now actually one of Australia's lowest cost gold producers. So on a quarterly basis, it is either the lowest cost or the second lowest cost gold producer, and therefore, the highest margin gold producer in all of Australia. And so we are building our Tunkillia project strategy and the pathway forward on that to emulate this success and emulate it. We have been doing, when we acquired Tunkillia, it was about a 550,000 ounce asset. We grew it to 965,000 ounces in 2020, and we have just recently grown it to 1.15 million ounces, and we intend to grow it again by the end of the year. So again, following a simple but proven model for high volume, high profit operations. And certainly if we can achieve even a fraction of what Capricorn have achieved, our shareholders should be in for strong rewards. So looking at, the totality of, what we've done in the past 2 years, we have been listed for 2 years now. During this time, we've brought in a lot of new technology. We've done an incredible amount of work on the ground to build momentum towards this sort of ultimate stage two plan. We've done about 31,000 meters of drilling. We're about to kick off further major drilling programs. During the past 2 years, we have already found 4 new gold zones, which have more than doubled our known gold mineralized strike around our projects. The South Australian government is a very strong supporter of ours, so they've given us nearly $1 million in grants to co-fund our projects. And importantly, as we touched upon on sort of our opening, we have so the unique circumstances of being a cash generative explorer developer. So we are probably not best thought of as an explorer developer, but really an advanced asset manager who happens to be operating drill rigs. Since we IPO'd, we've generated over $5.2 million in net additional free cash that's non-dilutive. So net of the cost of running sort of various special projects, we've generated this $5.2 million in cash. This has strongly subsidized the work that we're doing and also protected shareholders quite considerably from any further dilution, from funding that we might have required. And the big news for us recently has been actually that following the news of a rather significant and very cost-efficient resources upgrade at Tunkillia, we actually had a number of institutional investors join our register at a very attractive price with very low dilution for Barton shareholders. So the strategy, both in terms of the exploration and the corporate side, is really paying off. And I think the awareness of what we're doing on an international platform or an international basis is really growing. So let's step into the assets now. I'll take you guys through the projects. And we'll start with Tunkillia. So again, starting with that kind of 5-year middle distance target. The key takeaway for Tunkillia, if we think about the region, is that we are at this very interesting triple point of geology where you have sort of 3 complexes coming together. And where these complexes are coming together kind of at the seams, we have this very, very large shear, sort of systems of shears. This is a broad kilometers wide set of shears. And where we're really focused is the Ural Brinda shear zone on one of our main tenements there. We've got about 30 kilometers of strike. And in the very northwest of that tenement is where we're sort of focused in the first instance. So if we zoom in on that area, what we're looking at here is an area that's about 5 by 5 kilometers, and it hosts our 223 deposit. So the 223 deposit is the cornerstone deposit of our Tunkillia project. It's about 2 kilometers long. We have grown that twice in our ownership, again, from about 550,000 ounces to 965, now 1.15 million ounces. And we have also now identified 3 new gold zones in the near vicinity of that project. So we are starting to prove or demonstrate to ourselves that this shear zone is actually mineralized on both sides of that 30-kilometer long shear zone. And we also are finding repeats of that style of mineralization. So it's getting quite exciting. When we step into that 223 deposit, what you can see on the screen here is a long section demonstrating how we have just systematically extended and smoothed the base of that resource shell in 2 iterative stages of resource growth in 2020 and 2023. And this latest resource growth for us, which we published at the end of April, has been quite rewarding. It was actually not only a significant resource upgrade, but it was also very cost efficient. So we were able to add about 189,000 ounces to this resource at a cost of only about $12 Australian per ounce on an all-in basis. So, dollars per ounce is often quoted just on a drilling basis. This is drilling and assaying and surveying and labor logistics, everything. So that's really bottom of the global cost curve for new ounce addition. We are following this up again for further growth. But importantly, the way that we're modeling this asset, again, with a mind to expansion and high confidence expansion, is that we're not really modeling this as a promotional resource, if you will, right? So not to cast aspersions, but much of the market so the stage of exploration development is focused upon the promotion of an asset. We really have a production mentality. So we've actually imposed very, very strict modeling in this resource. We've modeled it the way that you might think about modeling a production resource. We've actually imposed very strict grade capping, which has reduced our estimated grades. And we have also actually allowed into the model an internal dilution. And what I mean by that is we have built a model to assume that we mine straight through waste that's in the middle of the model. Because what is happening as we're modeling this now, and what we're discussing really for the first time with this asset publicly, is that the geometry of this geology, if you will, is starting to look very interesting. And there's sort of 3 key characteristics that kind of jump off the page when we look at the shape and nature of this mineralization. The first is that the deposit has a bias towards shallow, in simple terms. So about 80% of the resource and ounces are within 200 meters of surface. The second is that there is actually a 300-meter long high-grade zone in the center of the deposit. So what you're looking at on the screen right now, you have a 3D image of the deposit on the left, and on the right-hand side, that is a cross-section through the center of that deposit. And what you can see there is that you have this very broad mineralization. So these are sort of 80 to 100 meters of mining width. So if you can imagine tipping a football field end to end, that sits inside of the mining width of our project. So this is very big, very bulk, very efficient style of operations. And this is why I was saying we allow internal dilution. If inside of a 40 or 60 or 80 or 100-meter mining width, you come to 2 or 3 meters of waste, you're using big bulk equipment. You don't even slow down. You go straight through it, and it all goes through the mill. And the reason is the cost per unit of mining, or per cubic meter of dirt removed, is dramatically lower for large scale equipment than it is for these small scale equipment that you would use to selectively remove that style of waste. So big bulk open pit. And then what you can see in that center as well is that it is actually a high grade central zone. So we would be developing down to start this operation on mineralization that has mining blocks that are up to 5 to 10 grams per ton. And then the third interesting really feature there is, as we open that main central pit to go into our stage 2 expansion, and you start to produce that higher grade mineralization, if you look along the top of this deposit, and we have this shaded in sort of a light opaque blue on the three-dimensional image, there is there's a 2 kilometer long supergene zone. And what this means is there's an enriched zone that sits along the whole top of the deposit. It's between 1 to 200 meters wide. It's between 10 and 20 meters thick, and it contains about 225,000 ounces of gold near surface. So as you develop that central pit, and then as you start opening it to the north and to the south to get into big bulk operations, it actually is being paid for. The work to open that up is actually being paid for by that shallow supergene blanket. So it's very, very exciting for us. And then again, if we step back and think about the big picture, zooming back out, looking at the regional district, we think the 223 deposit will continue to grow, but everything that we've been looking at is really just in the northwest corner of that shear. We have another 25 kilometers of untested shear there. The same models that we have built that have correctly predicted new mineralized zones previously predict new ones down that shear. So we are going to be aggressively following that up, both in terms of growing that resource and regional exploration later this year. In fact, we'll be drilling quite shortly. And again, big picture strategy. If you had these big bulk operations, which we hope will be very, very cost efficient and profitable, you would really love to have some additional high grade ore nearby, because if you can add additional high grade ore to supplement this, it's really just cream on top of cream in terms of profitability. And this is where we look to our Tunkillia project. So, sorry, our Tarcoola project, beg pardon. So again, for frame of reference, we're just 70 kilometers north. So this is really a satellite to this stage 2 operation. But Tarcoola is actually the home not only of South Australian gold, but South Australian high-grade gold. It was the site of South Australia's gold rush in the late 1800s. It produced high-grade gold through the early 1900s. And then fast forward 100 years, a mining lease was put in place, and high-grade gold was produced during 2017 and 2018. So that was that open pit you saw on the cover of the presentation. And that mineralization was being trucked to our mill at a grade of about 3.8 gram per ton on average during 2018. So we have the ability to sort of build up mineralization here, where we've got this sort of hundreds of historical high-grade mineral occurrences. We can use this mineralization as we build it up to supplement and blend in high grade to the bigger picture 150,000 ounce per annum target, if we think about that stage 2. But critically, as we build this mineralization up and we add high grade resources to our overall picture, these become resources that we can bring forward and put through our mill. And that allows us to advance a stage 1 operation, utilizing a fully built mill that we can cheaply recommission. In fact, we recently had it valued for insurance purposes, and with an estimate that it would cost about $140 million to actually build and replace this mill if we had to. So it's a very cheap drawbridge to cross, if you will. And it means we're, $140 million in 2 to 3 years of permitting ahead of anybody else who might look to develop a project. And that mill has proven logistics here. So we can start a stage 1 operation. We can generate, 40 to 60,000 ounces per annum production, generate $40 to $60 million in free cash flow, and then use that to expand into stage 2. So why are we excited about the potential of that pit and its potential repeats of it? If you look at the pit, it's a very shallow pit. The long section you see on your screen now shows it was actually developed only to about 70 meters depth in its deepest point. That pit produced somewhere around 30 to 40,000 ounces during a short period of time. And interestingly, the prior owners were a little bit cash constrained, so they weren't actually able to invest in depth and strike extensions of mineralization. We've extended the mineralization to 200 meters depth below the current pit floor, but we've also found this entirely new gold zone, which we've called Perseverance West, and that sits just behind the southern pit wall. You can see the type of grades that we're intersecting there. So that's not a walk-up drill target, but a walk-up mine straight through the pit wall and into that mineralization target. And we can send that to our mill because we know that mineralization processes at about 94% recoveries. But as we step out again, think about the big picture. The big picture really is the bigger picture. So looking at the left side of your screen now, this is an image of the mining lease at Tarcoola. And what this shows us here is basically the Perseverance pit. And we've identified three targets that we think actually structurally are likely or could potentially host repeats of that high-grade mineralization. And this is based on geophysics and drilling and mapping and historical high-grade operations, similar to the one that led to that pit being dug out. So on that fully permitted mining lease, possible that we could, one, put some fairly significant new resources on that open pit. All that drilling currently is not in JORC resource, and we're looking to actually convert that into JORC resource this year. But if we can find a few repeats of this, we could have our entire stage one operational supply of ore for several years just on this fully permitted mining lease. We can start mining this tomorrow if we like. But then again, as we step out just a little bit further, the image on your right shows a seismic picture of the 15 kilometers covering that mining lease and to the west. And what this shows in very simple terms is we have gone and built a new regional structural model. And we've labeled there in a very thick line the Perseverance shear. Now, this shear is the shear that created that high-grade open pit on our mining lease. So it's nice to know where that gold comes from. You can see that shear passes through the Tarcoola formation. That's the source of mineralization in the region, in the central Gawler Craton there. And that plumbs directly into one of those red traced bodies there. And those are granite intrusive bodies. They're part of what is known as the Hiltaba intrusive suite. And these are the same engines of growth that sit just to the east underneath Olympic Dam, which is the world's biggest everything deposit. In fact, one of the world's biggest gold deposits too, is even though they don't mine it. So that's very, very interesting to know where that comes from. But what is equally interesting to us is as you look across the 15-kilometer long span to the west, we've identified a dozen or more parallel and cross-cutting structures that are perfectly analogous to that structure. So they pass through the same mineralizing formation and they plumb into the exact same intrusive body. Importantly, where they come to surface, they're pointing like arrows to targets that we had already identified as very attractive exploration targets based on surface geochemistry and analyses, one of which was actually drilled by Anglo Gold in 1997, and that's that target labeled Warburton. Now, Anglo Gold drilled there based upon a geochemical anomaly. So they drilled blind. They didn't have any structural knowledge, but they drilled 16 meters at 3.5 grams per ton from surface. Now, today, you would be very excited about that and you'd follow that up quite aggressively. But in September of 1997, when they got those assays, the US dollar gold price was $300 and falling. And they did not actually have the structural context to understand why and how they had hit that. So we have actually backfilled that story. And so between the mining lease, where we think we may have a cluster of these high-grade open pits, and the short distance to the west on our exploration license, we think we may actually have a cluster of clusters. And what we are doing right now to actually kick off a very aggressive drilling campaign is we have just completed line clearing for a new shallow seismic program to sharpen the resolution of the subsurface imagery and to basically sharpen up our targeting. So we're going to be collecting new seismic imaging starting in a couple weeks' time. And then we're going to aggressively follow this up with drilling across all of these potential high-grade targets throughout the balance of 2023.
I'm so sorry, Alex. You're rather overshooting time. I do apologize. Is it possible to wrap up, please?
Absolutely. I'll wrap up right on this one here.
Sorry.
No worries. So what we're going to be doing for the balance of the year is continuing to grow that Tunkillia resource. drilling across our Tarcoola targets. We'll be looking for new resource upgrades both at Tarcoola and Tunkillia, and of course, continuing to sell more gold as well. So apologies for the overrun.
Not at all, Alex. It was absolutely fantastic. Absolutely fantastic. Now, I'm going to be naughty and just ask you a very broad and general question. That was so analytical. What is your background?
So my background is structured finance and economics.
Because that's a very unusual presentation you've just given us. That was so precise and so detailed. You were a surgeon of the mining world.
Well, I don't know about that. Look, again, what I would emphasize above all is we've really focused on team. My job is to think about strategy, capital, and sort of management. And we have an extraordinary exploration team that have really put together quite a compelling proposition.
Well, it was indeed a compelling proposition. That was a very interesting presentation indeed. The second point I would make, my ad hoc comment, would be that you've just grade is king normally, but you've proved that Capricorn and you think very otherwise. Grade is not king.
Correct. In fact, several of the most profitable operations in Australia today, and certainly many of the most profitable operations globally, are actually 1 gram per ton ore bodies. But Australia just happens to be known for deep, high-grade underground gold mining. The issue there, as we see it, is deep underground gold mining is essentially the act of sucking golf balls through a garden hose. It's very hard to get efficiencies of scale, and a lot can go wrong. And hundreds of millions of dollars can go wrong between surface and 2 kilometers underground. So we favor simpler operations because you can achieve you can take efficiencies of scale. You can ramp up production that way.
Now, you've told that story very compellingly, Alex. Well done. You've been reopening an old mining district in South Australia, breathing new life into it since 2020. What advantages does a brownfield site bring?
As you pointed out, it's an existing district. This is a huge mining district where BHP is operating. We have several iron ore operators. This is a district with a lot of knowledge, a lot of experience, very, very rich mineralization. And because we have fully permitted mining leases, it is a much lower cost, lower risk, and shorter timeline for our ability to sort of push the green button, if you will, and start operations. Of course, using a mill too, we've got about $100 million advantage over somebody else who needs to actually develop a mill that isn't there.
Now, my question was going to be, what makes you believe you've got a pathway to 150,000 ounces gold mine in and around the Gawler Craton? But I'll be perfectly honest, I've never heard anyone actually answer that question better. You've already answered it completely. How did you come across this as a concept? Where did the thinking come from?
Yeah, so back in 2016, we were doing essentially, if you will, global analysis on potential long-term macro trends. So my job was basically spotting the trend and identifying where we wanted to position a family office that I was running. We decided on gold. We narrowly focused in on Australia in terms of jurisdiction, operating cost base being in Australian dollars. And naturally, you want to look for assets where you have an infrastructure advantage, which is either the access to it or the ownership of it. Infrastructure is really the defining characteristic of successful operations. So it's probably not a unique or a surprising proposition. What is unique is the ownership of the infrastructure in that region, and it does sort of make us masters of our own destiny, and the ability to cheaply start, say 50,000 ounces per annum of operation, and then just fund our own growth as opposed to sort of being hostage to constrained funding, which is really the challenge that stops many great projects, is the need to spend $250 million or $1 billion to get into operations. It's an almighty jump that sometimes can't be achieved.
Do you see yourself mainly being self-funded?
Look, we have demonstrated a pretty strong track record of generating internal funding. We will sell the gold concentrates or process them that we've been generating, and we are actually looking at starting up potential additional processing or production of concentrates from our existing stockpiles, which we do have. So we think we're in a pretty strong proposition to actually make the transition into stage one operations without much, if any, additional equity capital raising. And of course, we have my background is banking and finance. We have very strong relationships across not only equity providers, but standard credit providers, but also non-standard credit providers, so trading houses and all sorts of structured financiers. So I think we're in a good position to make that step in a responsible fashion. But we'll always be quite careful about treasury because cash flow are king.
Okay. Um, will you be pushing hard to increase resource in the four new gold zones which you delineated in one of your slides there?
Correct. Yeah. So the rest of 2023 will be focused on one, increasing and essentially crystallizing more scale on that stage 2 platform, and then also crystallizing some of the early, let's say, stage 1 resources that we want to put through our existing mill. So we want to come to the end of this year. We've got about 1.3 million ounces of gold now. We want to come to the end of 2023 with somewhere closer to about 1.5 million ounces or more. And then during 2024, of course, we'll continue to grow these things, but we'll be starting to turn our focus forward. We talk about 2023 being a transformative year. We'll be turning our focus forward to start looking at in what order and how do we start turning these things back on.
When do you expect production, and even in its earliest stages, you mentioned that it was going to be phased in a very clever way. When might the kernel of production start?
Yeah, look, it's always a hazardous question. But if we have a 5 year
Sorry, and it's
target
the
for
middle
the
of the
kind
night as
of
well.
middle, well, let's just say we have a 5 year target for our sort of our 150,000 ounce plan. Every 50 or 60,000 ounces that we add at Tarcoola, which is higher grade, 2 gram plus near surface, that brings forward production that we can start by a year because that will produce 40 to 60,000 ounces per annum through our existing mill. So what we're looking to do is to find 2 or 3 years of, let's say, operational runway in terms of that mineralization and start stage 1 operations. Now, that could mean 2025, but we also sort of have, if we sort of think in these terms, we also have the potential for sort of smaller scale stage zero point 0.5 operations, just consistently producing more high grade concentrates from our stockpiles, which we have been doing on an increasing basis since we IPO'd.
So when might the care and maintenance mill, when might the care and maintenance element stop?
So I think to turn on that mill, that's when we would be looking at engaging full scale operations. So that's you might look at that in 2025, but we could conceivably actually use just the crushing and grinding circuit of that mill to actually crush, grind, and produce a concentrate of some of our existing stockpiles. So there is a potential to even though that asset is a very simple reanimation, just to ease that back into operation and be using it to actually using the front end of the mill to produce gold concentrates during 2024.
Okay, which neatly takes us to the one of concentrates. Tell us about the concentrates, the ore, the tailings, all the possibilities that the asset that you purchased actually holds.
Yeah, so I mean, in really simple terms, when you acquire an historical operation with a mill, you often acquire much more kind of scattered around on the ground. And so, we've been collecting concentrates out of our mill by doing, first we did a gold room clean out last year, and we sold about 1.5 million Australian dollars worth of gold from that. In December, we actually disassembled the gravity circuit and cleaned that out and collected about 10 tons of gold bearing concentrates from that. We've been systematically cleaning those and preparing those to a saleable concentrate. And we now have about $3.5 million stockpiled of gold and concentrated around 5,000 grams per ton from that. So we also then look across the site. We have probably around 300,000 tons of lower grade stockpiles. So stockpiles between 1 to 1.5 gram per ton at our mill site, as well as the Tarcoola site. And we also have some other smaller, potentially higher grade stockpiles. So we're selectively working through those and doing metallurgical analysis to figure out what would be attractive to process to a concentrate, and in what order. So there's a lot of potential in all these stockpiles. And the things like tailings, as you mentioned, this is a high grade historical production site. Production grades, or the head grade going through that mill, were 5 to 10 gram per ton historically. So there are potentially significant gold credits in the tailings facility, but there's also potentially other mineral credits that were not previously economically viable. So we're actually going to go through and test the tailings facilities to see if we don't actually have a 6 million ton deposit of other minerals right there that we can just reprocess.
Alex Scanlon, you're a complete star. On the one hand, we shot over and it went all over the place. On the other hand, what a fantastic education that was. That was a compelling telling of the story. Thank you so much. 3 o'clock in the morning.
Thank you very much for having me.
Well, I can't believe you're that good at 3 o'clock in the morning. I certainly wouldn't be, Alex.
Well, we try to be good every day, but thank you very much for having me, and apologies for running over.
No, not a problem. Alex, that was terrific. Thank you so much.